Gold. It's shiny, it's scarce, and it's valuable. It's also one of the most popular instruments in the financial market. But how do you actually trade it? There are a number of ways a trader can access the gold market. Let's start with the first and shiniest option, physical gold. If a trader buys anything gold, such as jewelry, coins, teeth, or simply heavy bullion, they'll be following in the footsteps of their ancestors, who have done it for thousands of years. The idea is to buy it, store it, and sell it at a later date when the price has risen. However, these days the storage, delivery, and insurance costs make this a much more expensive, less efficient, and less liquid method than trading online. The majority of the world's gold is held by central banks, but a lot of the rest of it is held by big company syndicates as part of an intricate storage and distribution network of gold bullion. These networks facilitate the trade of gold around the world and even allow traders to trade gold without having to take delivery of the gold itself. The most important network is the London bullion market, which sets the global benchmark gold spot price. Right, so what if you don't want to trade physical gold? Well, you can trade what's known as paper gold, and one of the most popular methods is futures. Futures contracts are contracts in which the buyer agrees to take delivery from the seller of a specific quantity of gold at a predetermined price on a future delivery date, allowing traders to speculate on whether the price of gold will be higher or lower on that date, either making a profit or a loss on the payment and delivery date. However, this delivery is usually settled in cash, so the buyer doesn't have to deal with the gold itself. But be sure to check the contract, or you might have a load of gold turn up to your home. Now, the three main regional markets for gold futures globally are the over-the-counter or OTC market in London, the on-exchange COMEX in the US, and the Shanghai Gold Exchange in China. Another type of gold trading similar to futures is options. Unlike futures, options give the trader the option, not the obligation, to buy or sell gold at a certain price, known as the strike price, on a certain date, known as the maturity date. A trader either takes a call option, which gives them the right to buy, or a put option, which gives them the right to sell. As the trader is not obligated to buy or sell, they must pay a premium on each trade. Again, the biggest markets are in London, the COMEX, and Shanghai. Now, if traders don't want to deal with the nitty-gritty of contracts and the actual asset, then a more simple method is gold funds. Gold funds are split into two options: mutual funds and exchange-traded funds. Both are traded digitally online. They're investment vehicles that give traders exposure to the gold market without investing directly into the commodity itself. Okay, so let's start with exchange-traded funds. The biggest and most popular gold ETFs, like the SPDR Gold Shares or iShares Gold Trust, simply aim to track the price of gold in real time. There are also ETFs which contain a basket of gold mining companies that traders can explore. ETFs are traded on exchange, just like stocks, and traders can go both long and short, as well as trade them on margin. ETFs don't have an exit load, which is a fee that investors must pay in order to exit the trade before a specified time, which could potentially make them more suitable for shorter-term traders. There are many different ETFs that all have different fees. The fee is usually small and in the form of an annual interest payment. Now, mutual funds, on the other hand, are over-the-counter and are purchased from financial institutions like banks and brokers. They usually consist of a basket of stocks of gold-producing or distributing syndicates, stocks of mining companies, gold ETFs, and physical gold itself, or a combination of all of them. These funds are more diversified, and because of the nature of share prices, potentially offer traders exposure to gains higher or lower than the price movement of gold itself. mutual funds are actively managed, which means they're generally more expensive than ETFs and charge ongoing fees. The price of these funds is posted at the end of each day when a trader is able to buy them. They may also charge an exit load, which means if a trader exits the position before the stated contract time, which could be a year or even 10 years, they'll be charged a certain amount to do so. Gold mutual funds are usually part of a systematic investment plan, or SIP, as investors usually pay into them monthly or annually as part of a more long-term strategy. Gold is often popular with long-term investors as it's seen as a good hedge against economic uncertainty, geopolitical risk, and inflation. Of course, traders can also explore investing in singular gold mining stocks that are on exchanges, rather than as part of a fund. Right, moving on to our last method, which is CFDs. Contracts for difference are contracts between a trader and a broker. When a trader enters into the trade with a broker, they are not trading in the underlying asset itself, but simply on the price movement of that asset. This means that they are not subject to standardized contracts, allowing brokers to be more flexible in their offering. Here at Capital.com, for example, we offer CFD trading on the spot gold price, gold ETFs, and gold mining stocks. Then there are also CFDs and other over-the-counter derivatives for gold futures and options. CFD trading allows for the use of leverage, which gives traders the chance to increase the size of their position with a loan from the broker. Beware though, it can maximize both gains and losses, and it's highly risky. I hope this has given you a good insight into the world of trading gold. For more videos like this, check out our channel. And don't forget to like, comment and subscribe.